Good morning and welcome to Real Estate Economics webinar series. I'm John Mulville, Vice President of Consulting here at Real Estate Economics, and I'll be leading you through today's look at the Victor Valley area of San Bernardino County. Today we'll take a look at the historical perspective, new home market trends, a closer look at employment, and finally generate some summary and conclusions of conditions in the Victor Valley. We always find it helpful to take a little bit of a look at the historical background for any area. It really sets the stage, particularly in regards to distress, current conditions on the ground, and really sort of the underlying home or residential market foundation for a particular area. Those of you who are familiar with our closings report have seen this data before. This is a distribution of housing transactions for this particular market area. Blue dots show resales. Now that is a category that can include short sales. Green dots are new home sales. That's from a conventional subdivision. Yellow dots are foreclosure sales. That is lender out to new third-party owner. And red dots are foreclosures. That's from owner back to lender. The time period here is 6 months. We want to have enough data in these samples to get a good representative read on what's taking place on the ground. So this is September 2006 to February 2007. If you recall this time period, the U.S. economy was performing quite well. This is well in advance of the recession, well ahead of Lehman Brothers. This particular market is running about 56% resales. We would consider that number to be surprisingly low. That number ought to be in the 80s, possibly even the 90s. The new home market share at 34% right there suggests that this market is hugely overheated. As we all know now, it was subprime related, but these numbers of new home sales should have been telling us at that point in time that the new home market share was very outsized and was probably at tremendous risk, at least on the affordability side. We'll talk to that in upcoming slides. 4% foreclosures and 5% foreclosure sales. Those numbers sometimes seem daunting, but it's important to remember the U.S. economy has about 4 million people changing jobs every month, and so there are always people leaving their job, always people taking new jobs. We tend to be very focused these days on the employment report. Are we getting 200,000 jobs? The unemployment report, do we have 350,000 new people on unemployment claims? But it's widely overlooked how many people are changing jobs and staying employed at any point in time. And this is the sort of thing that creates the churn and the steady activity in any of these markets, people constantly coming and going. Let's move forward 1 year. This is February 2008. That would actually be the last month in the time period. So the full 6-month window is September of 2007 to February 2008. You can see a tremendous character change has taken place on the ground in this market. 45% foreclosures, 14% foreclosure sales. New home sales are still larger than we would normally anticipate at 18% and resales at 21%. Now at this point in time, this is still prior to Lehman Brothers, still prior to the election, still prior to any official beginning of a recession. But what has started to happen here in this market is that job growth has slowed dramatically. We're not in a condition of job losses at this point, but we have rolled over from steady month after month after month of adding jobs, particularly in the Inland Empire, to a situation where job growth has decelerated hugely. Many people went into this market hoping to acquire a home and using, frankly, loans where they didn't have to prove their income, but they believed in many cases they could make these numbers because they'd been getting in over time, and the employment picture had looked pretty good up until sometime just prior to this, when all of a sudden that overtime went away and people who moved up here had a much more difficult time keeping their jobs. Well, let's go forward 1 more year. This is the same 6-month period, September to February, in this case September 2008 to February 2009. Now we've had a significant national economic change in that the recession has officially started, and now Lehman Brothers has also taken place. And I just use Lehman Brothers as really the defining point in time that we could view the market as being affected by a severe credit event, credit crisis. So at this point in time, we've got 40% foreclosures, 42% foreclosure sales. So a whopping 82% are in the distress categories, 2% new home sales, and only 13% conventional resales. We're really somewhat ahead of large numbers of short sales taking place. So most of these are really just straight seller to seller without there being any distress in terms of a short sale. So this is 2009. Now think, we've just had a new inauguration, a new president coming in, but more than that, we've had just a whole bunch of economic events take place in the 6 months and year prior to this. Let's come forward one more year, full year, or for the period ending February 2010, the full period September 2009 to February 2010. And we have a little bit of a character change here. We are still having tremendous number of foreclosures, but now foreclosure sales are already outstripping foreclosures numerically. So the lenders up here have responded fairly well in that we've got foreclosure sales moving out in fairly decent volume. Resales, now we're starting to pick up some short sales as the lenders really have begun to recognize that their recoveries are far higher in a short sale than they are in a foreclosure sale. And they're also beginning to realize that if you let the tenant or let the previous owner stay in there, even if they are not paying, they're more likely to mow the lawn, flush the toilet, and really the period where we saw a lot of damage by unhappy owners, that lasted a little while, but the appraisal communities told us that didn't really last very long. You know, there's still some examples of that going on today, but that wasn't a trend that lasted forever. It makes great media, but it just wasn't a hugely widespread undertaking. So by this point in time, you know, we've got a market that's obviously in severe crisis, and the distress remains quite high. Come forward one more year, February 2011. The situation numerically is improving slightly. The total foreclosures and foreclosure sales are still quite high at 65%. Resales now, including many, many more short sales, are up to 30%, and still new home market share amazingly at 2%. Here's the last period. This is up to current data in the last month of February 2012. Full period September to February, so all these periods overlay as we've mentioned. Look at the total distress in the pie chart, about 57%, new home sales 3%, and resale category, again, many short sales in here, 37%. So this is the market really as we sit today. We know we've had the lenders on the sidelines with moratoriums, and they've all been sued, and they were trying to reach an accommodation with the various attorney generals. It is probably likely, in many markets anyway, that we'll have an increase in short sales, increase in foreclosures at least for a few months while the lenders start to catch up. Many of the lenders have effectively rebuilt their asset management departments, you know, really from the ground up over the past 5 years, and their capabilities ought to be increasing to the point where the volume and the pipeline can be dealt with much more efficiently than it was in 2009 and 2010. Now we're going to take those same 6 periods that we just looked at historically and see what that looks like on the bar graph. 2006 and 2007 average price $341, $340, and average price per square foot, you can see at the top, $174 per square foot of living area. You can see what happened to the trend over the next 2 years, a huge cratering in terms of both home prices and value ratios, all the way down to $61 in the current period. I would make the contention that both the highs and the lows in this market are severely overstated, and here's why. In 2006 and 2007, new homes, executive homes, discretionary homes made up a very large percentage of the total sales pie. We saw that earlier. I think it was 34% were new homes and homes in brand new subdivisions, all at the top of the market, all with big numbers, all secured or acquired with subprime loans. So that 341, 340 is really a function of the market share attributable to new homes. Look what's happened over time. That profile of percentage has changed dramatically and come down, down, down. So at this point in time, that 123,380 is just really the mirror opposite of where we were 6 years ago. That number is completely dominated by distressed sales, foreclosures, foreclosure sales, that sort of thing. So not only have we gone from the newest, most modern, biggest houses with the least qualified buyers, now we're at the other end of the spectrum. We have highly qualified investors paying all cash for smaller homes that really fit the rental profile for this market area. You can see what the total volume looks like. Again, we're using our same September to February time period. Volume cratered in 07 and 08 as we talked about a little bit before. We were starting to lose some jobs here and people's confidence is quite shaken. Volume has rebounded tremendously in the subsequent years, really as foreclosures and short sales have helped lift those total numbers and keep those inventories moving. Also, we see here the single-family detached in blue and the microscopic condo share in this market. Obviously, the single-family is preferred by some 100 to 1 in terms of buyer preferences. Now we're switching to a 3-year chart. This gets awfully busy on more than 3 years, but the point remains that foreclosure sales are coming down period over period. Foreclosures are also coming down, and the resale category, again recall, that one that includes short sales, that's growing. Again, the lenders are using short sales as their preferred vehicle for asset management, disposing of units in their asset management department, selling their foreclosed inventory. I'm going to show this distribution in 2 periods. So let's start with the first period. Again, we're using our September to February, so the current period is 2011 to 2012, same months a year ago, same months 2 years ago. You can see what's happened in this market is nearly all, or certainly a huge majority of the transaction volume is now under 200,000. Big numbers in the 150 to 100. Those are very affordable. Huge numbers under 100,000. Now in the next slide, we're going to look at the 3 years previous to this, and you can see what sort of character change took place from the period 4 to 6 years ago compared to 2 and 3 years ago. So 6 years ago, let's just call it 2007, that's in the yellow. You can see how much activity there is in the 300 to 350, 350 to 400, 400 to 500, and so on. That's discretionary new home product, people going up the hill to get those big houses at much stronger values than they were down the hill, if you will. But then if you move over 1 year, to the period 5 years ago, remember that year had tremendously reduced volume. The market was essentially shocked, and that began the redistribution so that 4 years ago we were already in a severe correction. Look at the surge in volume in the under 100,000 category, an equally large, if not greater, surge in 100 to 150 and 150 to 2. Now, essentially that same pattern exists today where there's huge concentrations under 200 and very, very little activity, say above 400, where you might consider executive home and discretionary product to be. Overall, if you look at all closings, all closed sale categories, resale, new, foreclosure sale, the bottom total, see the total distress where we've added those up, still in the current period 58.2% of all transactions falls into that distress category. And remember, the blue resale numbers, those include short sales, so the 58.2 isn't a total figure on the numbers that would be considered motivated by some form of distress. Those numbers have been coming down year over year over year, but it really lets you get a picture of how long this distress is likely to draw on. Obviously, this is a intensely impacted market when it comes to distress, but we've really got some number of years worth of work for asset managers in this particular market area. Now let's look at values and value ratios. And this is the most recent time period, September 11 to February 12. I think what we'd like to call out here is we've got a troughing pattern, a little bit of basing going on. We happen to believe that the rental investor is a pretty effective, hardworking, innovative, adaptable, and determined creature and will tend to ferret out these rental units, the units with high rental potential in this market, and we see it in all the markets that we're active in. So these all-cash sales, if you look at these numbers, people can come into this market, buy one of these homes. So let's say you're using all cash, and the month-on-month rents more than cover it, even if you use an 80% mortgage. So you're immediately generating cash-on-cash returns in this market. You're buying quite cheap. We've heard rehab costs as low as $7,500, maybe $10,000 for some carpet, some paint, that sort of thing. And you've got a home that's up and rented, 3, 4, 5, 6 weeks at $1,200, $1,400. We've even heard $1,500 and $1,600 in some markets. Obviously, tremendous cash flow generation capabilities. Let's switch gears here and go to the new home market. So we've left the overall market, that included new homes, but it also was foreclosures, and traditional resales. And now we're switching exclusively to new homes and new home market information. This data is collected by Real Estate Economics quarterly surveys of these markets and all the active communities in these areas. First, I'd like to call out the number of active developments. This is an extreme situation where the market has gone from 86 developments, 91 in 2008, all the way down to 11 a year ago, and now we've bounced back up to 14. This is very typical, except more severe than what we see in almost all markets we deal with. Community counts have cratered across the Inland Empire and in many other markets outside the Inland Empire. Prices have come way down, but you recall the total market prices where they were 120, 130 on average. Still a new home market in 2012, approximately 207, 326. 202 net of concessions. Gradually, these numbers continue to grind down, in part due to what we'll show you here on the next slide. Average unit sizes, this is very typical across the region and almost all the markets we've been working. Home sizes have come down severely, 10, 15, 20%, as builders have really done their best to improve the affordability of product. Density has been going up in most markets we operate in. Home sizes have been coming down. This may not be quite far enough to secure buyers in great numbers. 2156 still going to put us, at the upper edge of the financial capabilities of this market, although we're pretty sure they would take that total number of square feet in their living area. Let's talk briefly about total market area monthly sales. Now this is the total monthly sales in all new home communities reported during this quarter, spread out to a monthly basis. What's happened here is the market area monthly sales has gone down faster than the number of new home communities have. So instead of really gaining market share at this point in time, the average new home development has not been able to maintain a steady pace. If you look at these numbers, 1.9, 1.8, 1.6 a month, there just aren't builder business plans that are built for this. This is a very tough situation to be in, of selling homes at one or two a month. Really, this market is asking and requiring for improved affordability, and still probably somewhat lower prices. Here we can see on the new home basis what the prices have been. We showed this on an overall market basis. Now we're going to show this on the new home basis. If you recall back to 2007, the overall market was about 340. The new home market's 362, so you can see to our earlier point that the average for the entire market mirrored to a great degree the activity in the new home market. Large volumes there, all at higher price points. But instead of coming down into the low $60 per square foot as the overall market did, the new home market has remained in the mid to lower 90s. These numbers still appear to be coming off a little bit, but we've got sort of a bumpy trough, we think, taking place. It's going to be quite some time, we believe, before the rental investors will clean up the distress in this market, so that's bound to put pressure on new home prices for the next few quarters. There are plenty of markets in the Inland Empire, we believe, that have passed this point, but being an outlying area, being an area that's dependent on automobile transportation to get to work, this area has tended to be a little bit behind the rest of the Inland Empire market progress. Just as a benchmark, let's look at the active new home developments in all of the Inland Empire. You can see this has got the same cratering effect. We've gone from almost 700 back in 07 down to 178 a year ago, bumped up ever so slightly to 183. But there's a couple things that's taken place here. One, most of the older, we call them legacy developments that were really designed for the executive home buyer, the discretionary buyer, that was active in the market in 05, 06, 07. A lot of that product, in fact nearly all of it, is gone. It's been tremendously discounted. It's been sold out, closed out, or gone to hold. So the communities that are active now are much better positioned to capture buyers. We still might have some price overstatement. We still might need to bring those numbers down a bit, but all in all, these homes are much more in line with buyers' demands now. One of the things that we think is going to happen in all these markets is in the next couple of years, energy costs are going to rise very rapidly in the state of California, and that's going to make the new, modern, energy-efficient home compare very strongly to all of the older housing stock. So all of the older housing inventories got built-in obsolescence, and it's going to really be one of the things that defines the home in the next cycle from the home in the last cycle. You can see, again, Inland Empire averages. We've looked at this on a local basis for the Victor Valley, but here it is for the whole Inland Empire. Same thing has taken place. We've had a tremendous drawdown in prices. Now we're down to 365,031. Getting closer here. We're getting closer, at least on an Inland Empire basis, where some communities are starting to do much better in terms of their absorption. They're not stuck at 1 or 2 a week, and we're starting to see some pickup in those new home communities that have their prices appropriately aligned with the financial capabilities of the people in their area. We'd like to just make a quick note about the total housing inventory. Housing stock has essentially stopped building, or is building at a very slow rate in these last several years. Less than 1% annual growth from the time period from 07 to 17. We would normally expect at least 1% of the entire housing inventory to disappear from these numbers every year through usually conversion to another use. You know how many single-family homes in highly trafficked areas become dental offices and small offices, that sort of thing. Some are destroyed, not too many. Some are old and have reached the end of their economic life. Not too many homes burn down in this area, so it's not too often destruction. But we would say this 1% growth is far too small for a market area of this size. If there's any employment growth, then it's severely too small. What this causes is all the homes in the existing housing stock are aging year after year after year, and they're not being replaced fast enough to even turn over the whole inventory in 100 years. This causes a general aging of the housing stock and makes the entire housing stock collectively less appealing to buyers and less competitive to employers to pull jobs here and to bring people to work in the Inland Empire. Let's take a special look at employment trends. Of course, this is a huge category of discussion across the state, across the nation. One of the big things that's really been affecting this market is there still tends to be a lot of people driving into LA County, particularly in the western part of San Bernardino County, the western Corona markets of Riverside County. They're driving into LA, driving into Orange. LA County itself has really underperformed on the job scene, not for a year, not for 2 years, but for 10 years and for a generation. You know, there's a whole bunch of things you could talk to about why LA County has not really done its share, if you will, of keeping the employment market healthy. There's a lot of anti-competitive practices within the city and within LA County itself. We know many of the schools are weak and a lot of the governance is not what we would hope it would be. That's really kept this area from pulling the kind of jobs, and it spills over to the outlying areas, and this is part of it. The picture is certainly not as negative in the Inland Empire, but the core, the largest job center, LA County, has just not performed well on a 10 or 20-year basis. This again talks to LA County in this particular graph. You can see the areas still losing significant numbers in government, information, manufacturing. We know LA County and the city is highly unfriendly to anything that creates smog, obviously, but just there's a lot of anti-competitive manufacturing rules. It comes at a time when really the U.S. has had a huge surge in manufacturing employment. There are many parts of the Midwest where energy costs are extremely low due to all the non-conventional drilling and natural gas production that's taken place. Employment rules are much different. So the U.S. has had a huge surge in its manufacturing base that really hasn't spread or been shared by California. Let's switch to the Inland Empire and see what those numbers look like. Government continues to come off in this area. Remember that the state law has essentially gotten rid of redevelopment agencies. That's taken a lot of employment out of state government, and also part of the American Recovery and Reinvestment Act acted to support government. Those funds are now largely spent or gone, and so we're seeing finally a drawdown in government that's probably going to go on for a little while here. But still, most of the categories in this area are performing pretty well. Construction hasn't really fully recovered, and if you wonder what goes on in financial activities, many of the banks, lenders, credit unions, these sorts of operations have been shrinking because of Dodd-Frank and just have found their footprint to be too big. The cost of serving a typical banking client has gone up under Dodd-Frank, and not as many branches are desired or needed. Let's look at the unemployment rates specific to the Victor Valley. We're going to talk about Adelanto, Apple Valley, Barstow, Hesperia, Victorville. All these areas still have severe double-digit employment. Of course, if you're reliant on cars and you're far removed from the employment base, you're going to suffer. Generally, though, overall, San Bernardino's been improving, Riverside's been improving. California was very late to the recovery game. The nation, recovered much earlier than the state. And Southern California has actually recovered much more slowly than Northern California. So sometimes you hear the headlines, the news, and it seems like everything's rosy and the national economy's really picked up. There are many areas that have. It's just California is lagging the nation, and Southern California is lagging Northern California. So really, what are our main points in employment? We just talked about this one of the last markets to emerge. Our huge base of distribution, warehousing, has been a benefit to employment in this area. That type of activity, warehousing and distribution, benefits from quantitative easing. The dollar is much cheaper and our exports want to go overseas. Our area has benefited from the growth of manufacturing, although unfortunately a lot of that manufacturing is in the Midwest and other states, but those goods are ultimately shipped here, repackaged and distributed, sent overseas from our ports of Southern California. The Inland Empire is got an improving competitive picture with lower housing costs and an abundant pool of labor. Now, everyone wants to have a bigger house and everyone wants to make more money, but if you look at it in terms of competitiveness with other states, with other countries, every MSA, every region, every state has to compete nationally and internationally, or employers just flow to markets where competitive conditions are better. There's really just no way around it. That's what led jobs overseas, and ultimately the U.S. is improving its competitiveness, and that is partly by having a good labor pool and lower costs of housing, as are developing in the Inland Empire. We also are a little bit concerned about the balance of 2012. We've got a jobs recovery starting to take hold. There's still some holes in this jobs recovery, and there still may be some developments on the jobs recovery that surprise people, but we think people are bound to be a little cautious in the back half of 2012. We've got a couple of ballot initiatives here in the state that'll raise sales tax and raise income tax, and also on December 31st, federal income tax brackets revert back to what they were during the Clinton years, which means that every tax bracket, not just the Warren Buffetts, not just the millionaires, every tax bracket gets an increase. People are bound to be cautious until they know what their take-home pay is. That's really, going to drive your ability to pay down your debt and to qualify for a mortgage. We'd like to take a second and talk about mortgage interest rates. Obviously, we're at historically low rates. We've got the lowest rates in the whole period going back to 1990, occurring in 2012 and 2013. Really, our real estate market has had interest rates as a tailwind all the way since rates peaked back in the early 80s. Every couple of years, if you didn't refinance or add, junior liens to your house, you could refinance and own that same house on a lower payment. You could have gone from 12%, back in the mid-80s to 8 to 7 to 6 to 5. All those things give the household more income and prove to be a tremendous boost for housing. In these forecast years, though, we've got a little bit of an uptick in rates taking place, and that has the opposite effect. That's going to require people to have more money to afford that same house, instead of having that same house with less money when rates were coming down, and there's that sort of tailwind. There's been some concern, I believe, that interest rates are going to rise quite quickly. I don't believe that's really the case. If you look internationally, it's obvious that the Chinese economy is slowing down, the Indian economy is slowing down, those BRIC countries, they call them, Brazil, India, China, Russia, all those countries are showing slower PMI data and generally have shown some economic weakness over the past 6 months and a year, so we doubt there'll be too much severe upward pressure on rates, at least until 2, 3, 4 years out. So let's just talk about a summary of today's data. We know that California's lagged the nation, but we're finally starting to see some improvement here. That economic recovery will strengthen and broaden, we believe, over the next couple of years. Again, there are some surprises, I believe, in the employment data up ahead. We'll just have to see how that plays out. But generally, the Inland Empire has finally been picking up steam and the recovery taking hold. Housing construction is still very low. We talked about supply. We have many, many markets where there is just simply not enough product to provide suitable choices for the people who are active in the market. Often you have to search an oversized geographic area for the house you want. You can't find the right floor plan, the right parking configuration. We have actually seen a couple of markets where supply increased and sales have doubled just because the supply has been totally insufficient in some markets, and particularly that's been evident in Northern California. Affordability is great. Foreclosures, particularly in our Victor Valley and some of our outlying areas, are still a severe problem. Those situations are cleaning up a little bit in close to job centers. High-value areas of LA, Orange, Riverside, San Bernardino have started to see quite a bit of cleanup in terms of distressed sales, but that needs to migrate to the outer markets before we'll see improvement across the board. New home prices, we've seen those coming down, but we know volume remains weak. That's suggesting to us we've probably got a little ways to go on new home prices. But we've also seen the market has got a severe overcorrection on the ground, especially as it relates to income. We know that people could afford more home if they were motivated to do so. We think we've got to see some resolution in regards to take-home pay and see sentiment really improve before people are going to take the chance and buy a house again. Next cycle, mature buyers. We know the demographics are great for mature buyers. We know younger mobile buyers. Now, are they going to really buy and lock themselves into a house after what they've seen over the past 10 years? Maybe, maybe not. We'll have to see how that plays out. It's probably going to depend market by market. But also energy efficient homes will be a big deal. And we think people behave cautiously through the balance of 2012. Those of you who've seen our webinars know our products, residential market consulting, site-specific feasibility, supply and demand, and our highly appreciated land value optimization work. Our closings report and most of the material presented today came from our web-based information tools, housing transactions report, or our closings report that you saw today. You've seen our development profiles and economic reports. Here's our group. Most of you know Mark and myself. If you're currently a subscriber or have seen anything of interest today, talk to Judy and Sandy. Here's their contact information. We'll post this webinar to YouTube for viewing at your convenience. Please check our website. We've been changing the webinar schedule around a little bit lately, and you can always find out what's coming your way next. We believe we're probably going to look at Dallas and some of the Florida markets in the coming weeks, with possibly a special topic coming out in the next month or so. Thank you very much for joining us today. Please call me, John Mulville, if you have any questions. We'd love to field your comments and talk to you about what's going on in your markets. Thank you very much for joining us, and please join us next week.